One of the biggest mistakes new commercial originators make is assuming that debt yield and DSCR measure the same thing. They don't. DSCR measures the borrower's ability to make the loan payment. It compares the property's net operating income to its annual debt service. Because debt service changes with interest rates, DSCR can improve or deteriorate even when the property's income never changes. Debt yield measures something entirely different. It compares net operating income to the loan balance. Since it ignores the interest rate and amortization, it's a pure measure of lender risk and collateral protection. That's why lenders rely on it so heavily when refinancing maturing loans or evaluating leverage. The simplest way to remember the difference is this. DSCR asks, can the borrower make the payment? Debt yield asks, if this loan defaults, how much equity cushion does the lender have? Strong commercial underwriters evaluate both because a loan can have an acceptable DSCR, but still have a weak debt yield if leverage is too high. Roughly 15% of the outstanding commercial mortgage universe comes due this year. TREP puts the number at $797.1 billion, with another $676.9 billion, or 13.45% of the total, following in 2027. Within the CMBS market alone, $76.6 billion faces hard maturity this year, and the bulk of it is backloaded into the fourth quarter, nearly $30 billion, or 39% of the cohort. One metric consistently separated the loans that refinanced cleanly from those that struggled. Debt yield. Why this maturity wall looks different. Many of the CMBS loans maturing this year were originated in 2016, when the 10-year Treasury averaged 1.84% and the 5-year averaged 1.33%. Coupons on those loans likely sit in the 3.5% to 4% range. Loans written today generally start at 6% and up. That gap between legacy coupon and current market rate is the whole story behind refinance risk this cycle, and it shows up cleanly in the payoff data. In 2024, $37.6 billion of CMBS loans hit their hard maturity. Only 56% paid off on time. Another 11% paid off late, and $12.3 billion remained outstanding past maturity. In 2025, $44.2 billion matured, 70% paid off on time, and $11.4 billion still went unpaid. TREP's data shows a consistent pattern behind both years. Loans that paid off on schedule carried debt yields of 13.3% to 14.4% at maturity. Loans that didn't were sitting at sub-10% debt yields. DSCR wasn't the variable separating those two groups. Debt yield was. What debt yield actually measures. Debt yield is net operating income divided by loan amount. That's it. No interest rate in the formula, no amortization schedule, no assumption about what refinance terms will look like 5 years from now. It's a pure leverage check. If a lender had to foreclose on the loan today and hold the note, what yield would that NOI represent against the balance owed? DSCR measures something different. It's NOI divided by debt service, and debt service is a function of the interest rate and amortization at the time the loan is written. That makes DSCR sensitive to the rate environment in a way debt yield is not. A loan written in 2016 at a 3.75% coupon could clear a comfortable 1.35x DSCR at origination while carrying a debt yield well under 10%. Because the low rate kept debt service manageable, even against a large loan balance relative to NOI. That's the trap. The loan looked perfectly healthy when it was originated because low interest rates produced an acceptable DSCR. But debt yield never changed. When rates reset at refinancing, DSCR deteriorated, while debt yield revealed the leverage that had been there all along. Why the debt yield threshold moves by asset class. Lenders don't apply one debt yield number across every property type. Multifamily generally carries the lowest debt yield requirement in the market, often in the 8% to 9% range depending on the lender and execution. Special purpose and owner-occupied assets run meaningfully higher, frequently 11% to 13% or more. The gap reflects how a lender thinks about the workout scenario, not just the income scenario. Multifamily has deep, liquid exit markets, agency execution through Fannie Mae, Freddie Mac, and HUD, and cash flow that's spread across dozens or hundreds of units, rather than concentrated in one tenant or one use. Owner-occupied and special-purpose properties carry more single point of failure risk. If the operating business fails or the specific use becomes obsolete, the lender is holding a harder asset to release or sell. The higher debt yield requirement is the lender's way of building in more cushion against that scenario before the loan is ever written. What this means for originators: I always underwrite to both DSCR and debt yield, not just the one the borrower's income statement makes look best. A property can clear DSCR comfortably and still fail a lender's debt yield requirement, and that gap widens the most in a lower interest rate environment. Exactly the environment a lot of the current maturity wall was originated in. If I'm only screening on DSCR, I can miss a deal that's thinly capitalized on a pure leverage basis and won't refinance cleanly when rates are higher at maturity than they were at origination. For anyone originating today, the practical takeaway is to run debt yield alongside DSCR from the start, and to know that the debt yield bar moves with asset class. A multifamily deal and a single-tenant owner-occupied deal with identical DSCR profiles can sit on very different footing once debt yield enters the underwriting. DSCR tells you whether today's loan payment works. Debt yield tells you how much leverage the property is really carrying. In a refinancing market defined by higher interest rates, lenders are increasingly relying on the second question to answer the first. Source: TREP Inc., the CRE Rundown.